Hey guys, what's going on? Welcome into the video. So in this one, we're going to talk about what played out in the stock market last week and what to watch for in the week ahead, including some important catalysts to watch out for and some trade ideas along with that. And as always, there are timestamps in the description. Let's go ahead and get on into it. So starting out, what played out last week was pretty simple technicals once again. So 2 weeks ago, this S&P broke out above this trend line we've been talking about, rallied all the way up to 42.27 from there before starting its pullback. On this pullback, it sold all the way down to backtest the previous trendline resistance as new support, and of course once it held, we saw that next market rally back towards recent highs on Friday. So taking a look at the bigger picture now, these key trend lines that we've been talking about are now at 42.42 and 42.75. These are both major resistances and have marked multiple swing highs for the market, and therefore are high risk to potentially put another swing high or top off of. Though buyers still continue to be well in control of the trend, for sellers to gain any traction, they need to get below 41.12 on the downside to start anything more than just another healthy pullback. Breaking and holding below there could start downside towards the major trendline supports, which are now at 40.32 and 40.20. For now though, the broader view is bulls are well in control of the trend, though the major trend lines on the upside are high risk for a top or a swing high. Along with this though, there continue to be quite a few warning signs down under the surface. Number one right now is it's looking like there may be another rate raise in the June Fed meeting. Just 1 week ago, as shown at the bottom of the screen, there was an 82% chance for no rate raise at the June meeting. Then that dropped then to 48% on Thursday, and on Friday it dropped further to 36%. So right now the market is pricing in a 64% shot that we get another 25 basis point hike on June 14th Fed meeting, and of course the higher rates go, the more pressure that it puts on the financial markets. Number two is market breadth continues to remain poor. As this visual shows, we are still seeing more net new lows than net new highs, meaning that there are just a select few of stocks that are holding the market up. This is a crazy visual to see along with that. The 7 mega caps, Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia are up an average of 44% in 2023, and the remaining 493 companies in the S&P are up an average of just 1%. This is obviously not sustainable, especially where valuations of the mega caps are trading at, and it's just a matter of time until they revert to the mean. If other stocks don't catch up and we don't see more of that broad market participation we've been needing, when the mega caps cool off, and that is when the pain will come back to the market and the indexes. An important catalyst going on right now is the debt ceiling as well. So if negotiators do not come up with a deal ahead of the June 5th deadline, then the US will default. Now don't get me wrong though, there is a tiny chance that would actually happen, but the more important thing to watch is the market's reaction. Based on what we've been seeing recently, it seems that the market is not fazed at all by this and has already priced in a deal happening. Because of this, I think this is a high risk to turn into a sell the news event for the market once a deal is announced. Maybe we see an initial pop in stocks followed by a pretty violent sell, which is what I'll be watching for and looking to trade. Alright, so now taking a look at some individual stocks and setups, starting out with Nvidia. This was an absolutely insane move last week after earnings when the company blew out their revenue guidance. This is what I wrote up last week in the Discord watch list, saying how I thought the company was likely for a beat and raise, where I'd be watching for potential blow off top after the report, though I had no expectation for the size of this move and the size of the beat on guidance. Overall though, in my opinion, there's no doubt that the stock is grossly overvalued here, but never underestimate hype cycles, which the market is experiencing with AI right now. For now though, I'm personally staying away from any positions in this stock and certainly would not short into new highs without a tradable pivot to limit risk. But for those who are feeling FOMO on this, aka fear of missing out, and other AI stocks, it's important to remember the hype cycles that these go on. This Gartner hype cycle chart lays it out well. It starts out with the technology trigger, sees a massive run up to peak of inflated expectations before a large drop called the trough of disillusionment, and then that evens out from there. For those who remember, we saw the same thing in 2020 and 2021 with electric vehicles. The Tesla chart is the best recent case study for a hype cycle. In mid-2020, it had that breakaway gap that started the next bull run. It built out a bull flag after that before another huge upside move from there, where it became heavily overbought and overvalued. Following that, it had a 6-month pullback and consolidation phase before starting its final squeeze higher, which then ended with capitulation from shorts and people saying that the stock will never go back down, which of course ended with that stock topping. Now I want you to ask yourself here, which phase do you think Nvidia is at? If you ask me, I think that is either at the heavily overbought and overvalued phase or in the capitulation from shorts phase. Where Nvidia goes from here, the hype cycle and AI will likely go as well because it is the leader, so just be aware of the risks. For those who are feeling FOMO, it's best to look for lower risk setups and stocks that have not already had their big runs, avoiding stocks like Nvidia and Microsoft. For example, along with this, the semiconductor sector has been hot along with the AI theme. One that hasn't ran yet is Global Foundries, ticker symbol GFS. This stock had a ton of hype behind it not long ago and is a pretty recent IPO from the end of 2021 and has essentially been basing the entire time. For a trade on this, it has some well set pivots. For example, it is testing the 200-day moving average now as resistance at 60.3. You can use this as a long entry on a daily close above it and then have a stop loss if it closes back below it to play the trade with low risk. Another semiconductor setup with low risk could be Qualcomm, ticker symbol QCOM. It just bounced off the key 100.7 to 101.8 zone, protecting its long-term gap with a strong bounce out of it once again. Now this one has some heavy overhead resistance along with the major moving averages, so it certainly won't be an easy move up from here, but there are some set in stone levels where you can keep risk tight instead of trying to buy highs on already a heavily overbought stock. Another good looking setup to keep an eye on here that has nothing to do with AI is Costco, ticker symbol COST. It is attempting to break out of this 1 year long wedge pattern on heavy volume. The breakout holds as long as it holds above $500 per share as new support, which could be your set risk level, with the next upside levels at 520, 535 to 540, and then 570 next above there. So that is everything that I'm watching for in the week ahead for the stock market, including the big AI hype cycle, the debt ceiling catalyst, and more for the week ahead. Hope you all enjoyed and hope I provided some value to you. If so, make sure the like button and subscribe button down below. For anybody interested in joining the private Discord chat, that is the first link down in the description to get my personal trade alerts, nightly watch lists, I answer any questions you have in there, and more. So thanks so much for watching, guys. I will catch you next time. Good luck trading this week, and peace out.